When a recession has its seeds in a financial crisis, you have a very different situation. There you have bank balance sheets that have to be repaired. Banks suddenly find themselves with a lot of bad loans on the books. They have to write those loans off. That reduces their capital base. A smaller capital base means they can do less lending. And they've just been burned, so they're pretty cautious. At the same time, consumers suddenly find the value of their wealth has gone down. If it's in the stock market, if it's in their house, they feel a lot poorer than they were before. They pull back. It's harder for them to get credit. They go through a process of deleveraging and paying off their debts instead of taking out more credit to buy a new car or a new washing machine or new refrigerator or take a vacation. There's a long healing process that has to occur after a financial crisis, and typically it can take 5 to 8 years to really fully recover from that. And that's exactly what we're seeing in the economies around the world today. After the deep recession of 2009, we have in the last year or so, particularly over the last 9 months, the progress on greater employment has been pretty steady, adding a couple 100,000 jobs a month. The unemployment rate's coming steadily down. I think that's going to continue. But it's a slow process, and we can't expect it to be fast. I suppose one can look back and say, if government policy was really on the ball, we wouldn't have let the bubble get so big that when it exploded, things really collapsed. And there are certainly some in the camp that say this should have been foreseen. There were measures that could have been taken. I think right now the government should really focus more on long-term actions that it can take to be sure we have a healthy economy that's capable of substantial growth. I think we could be doing a lot better if we had a path to showing that we were going to solve our total public debt problem and our annual deficit problem. If you look at the United States, with the policies we have in place today, if we don't change them, we're going to be in a very dangerous position in about 10 years. We'll have, our debt will be going up steadily as a percentage of GDP. I get very worried when I think about it going over 90% or something like that. I think we face the risk of having to pay very high interest costs out of the government and having higher and higher public debt. It looks unstable, and we have to fix some of the long-term programs that drive spending. We have to bring the cost of medical care down. We have to stabilize Social Security, which is easy to do if we do it right away, do it relatively soon. I think it's very important for the U.S. to get its house in order, to grow the economy, and that's how we're going to maintain a leadership position in the world, not just economically, but politically and militarily as well.